Our stock market has been down nearly 4 weeks in a row. Should we be worried or getting ready to buy? And are the banks looking actually cheap enough to be that buy? And it's time, or is it time, to bring back the tax deductible long lunch? Or am I doing this just to fatten me or fatten the skinny profits of all those restaurants and cafes out there hit by the coronavirus? I'm Peter Switzer.
I'm Paul Rickard.
And we're mad about money. All right, Paul, the market's looking a bit dodgy. The Americans are even down 5 weeks in a row. Should we be worried? Are you worried?
Look, I thought the correction was always inevitable, Peter. I thought the market had got ahead of itself, and we're now in that sort of second wave, type sort of part of the cycle. We're also starting to think that even if we have a vaccine, it's going to take months and months to distribute it.
Don't say that,
And I think the market's got ahead of themselves, Peter. So, look, I think the surprising thing is they got so far ahead.
Yeah.
And I guess we're just following the US, and the US is just having a bit of second thought. So.
Yeah. Could it be a couple of factors? Like in Australia, we rocketed ahead before Victoria. Victoria's made us pull back in a sense, hasn't it? It's slowed the recovery down, and the Reserve Bank sort of inhibited that. But in the case of America, the tech stocks rocketed along because everyone was sort of locked up. But now economies are reopening. A lot of those companies won't do as well. People won't be at home watching Facebook, doing Facebook and Netflix. So there's a bit of a rotation to other companies. That's another thing going on.
I think there's a bit of rotation. I find what interesting in the US is that they're taking a lot of notice of the new home sales as being sort of the key most bullish stat, which surprises me a little bit. But look, I think in Australia it's a little different, Peter. I mean, we've had so much money through all the stimulus, and that stimulus is starting to get wound back, and it's going to be harder for some of the companies that have done really well. I mean, the retailers, the discretionary retailers have been stars of the last 6 months. Yeah. They're going to find it a lot tougher, as will the supermarkets, and there's just got to be less money out there.
They can't keep on improving that rate.
No, and I think the market's just starting to sort of realise it's just going to be a bit tougher going forward. So we've had a great rally. We've followed the US up. The US has come back. We've come back a bit. I always thought we'd go back to 5,500. Look, we're not there yet, but I think that's, for me, is around about the next buy level.
What about Trump-Biden? There's a bit of Trump-Biden stuff in there too?
Yeah, I mean, look, obviously, we're through the most important electoral cycle there is, and we're less than 40 days out. So you've got to expect the US markets are going to be nervous at some stage about the prospect of Sleepy Joe or not, or even Trump just getting back in there. So, look, it's not surprising there shouldn't be a little bit of nerves. I think it's, they're predictable. The months of September and October we know are the tough months in the US market. Yeah. I guess we're going to sort of see that over the next couple of months.
And there would be some professionals who just actually took their profit off the table because they do worry about September and October.
Yeah, a lot of fund managers in the US have had fantastic periods. So why wouldn't you just bank on a bit of it?
All right, so I've thrown the question, is this buy opportunity coming up? And if so, are the banks a buy?
Well, the banks are getting closer to a buy. I mean, Commonwealth Bank down at $63 yesterday is starting to look a little more interesting.
For the long-term play.
For the long-term play. The other major banks getting around about a book value. Book value on all the other major banks is about somewhere between $16 and $17, and they're pretty well close to that now. So that's looking interesting. Again, we really don't have any handle on how this is going to play out in terms of bad debts, and that's not going to go away quickly. So the market's probably not going to be in any hurry to buy the banks, but they're getting back towards in that territory, Peter. So I have my eyes on down days. It's now time to think about the banks again.
Yeah, and Paul, remember this. The big fund managers aren't going to rush for the banks because the banks aren't going to improve in the short, even maybe medium term. But the long-term investor, the normal retail investor, they often take the lead from the biggies who are playing the short play. This might be the opportunity for a long-term investor to buy the banks at really good prices on the basis that in 2 or 3 years' time, they'll say, gee, I was smart.
Well, I mean, again, the reason why it might be an opportunity to buy the banks is there may not be as much damage as everyone feared. Remember, most of the banks in their COVID-19 models, and they're all provisioned for this, assumed pretty big drops in house prices. The housing market is holding up in most states pretty well. So it may be that the risk is not so much on the housing book, but more around some of their business loans. And we're going to start to see that as, because really, receivers have been quiet, right?
Insolvencies are record low.
They're doing, the insolvency practitioners are doing it really tough,
Yeah,
right?
sorry for them.
Maybe they might be starting to get a little busier over the coming months as the stimulus wears off. But I think that the banks are pretty well provisioned. So I don't think the market's going to re-rate the banks, but I do think it getting closer, Peter. They've been underperformers now the last 2 or 3 months, quite big underperformers. And they're starting to look a little more exciting. So I think it's still, play the market. You need powder in this market. I don't think we're behind the end of the correction yet.
No.
But there will be some good buying opportunities there.
Yeah, I think so too. Let's go to the final point. This is something I raised, Paul, in the Switzer Daily stories I've been writing. Is it time to actually look at the hospitality sector, really beaten up, particularly in Sydney and Melbourne, in the CBD area in particular, but even out in the suburbs? Restaurants that could take 100 people are probably only holding 50. Is it time to actually just pull away the FBT on entertainment and let businesses start taking clients and their employees out without a major tax
I'm all for they'll bring back the long lunch, Peter. I mean, I thought your introduction would never finish at the beginning there, right? So
it was a long one.
We all missed the long lunch, right?
Yeah, exactly.
And you've got to remember, this is one of Paul Keating's famous initiatives, right? With the introduction of FBT, fringe benefits tax, a horror tax that penalises employers from looking after their employees, right?
Yep.
And it's a very punitive tax, and it really had a huge impact on the culture we all enjoyed in the 80s, until Keating brought it in as the second best option when he lost option C. Was it option C or card C?
There was three options, and one was like a broad-based consumption tax, and Hawke said no. He said, right, we'll cop a capital gains tax on FBT instead.
FBT tax. And then, of course, we had the GST come in 2000 anyhow. So, look, I think the FBT tax needs to be looked at again. I think there needs to be some stimulus measure to get people back out there. Restaurateurs across Sydney, Melbourne, all the major CBDs are doing it really tough. I don't think I'd go for the Boris solution and pay people to go out to dinner on Monday and Tuesday nights, but get rid of this horrible FBT. It's a shocking tax.
And Paul, what you'd be sort of shocked about, I looked it up yesterday, it only gives 0.85% of the total tax the government collects. It's a really crappy tax even for raising, but it's 5 times more expensive to do the bookkeeping to look after it.
And it wasn't meant to catch lunches. The whole idea of the FBT tax was that a lot of companies, for example banks, had subsidised home loans. Other big companies rather gave people motor vehicles and paid for their kids' school fees rather than giving them salary. And that's what FBT was meant to do, was to put everyone on the same floor. It really wasn't designed to stop the long lunch, it did. We need to bring it back.
And the thing is, it's not just a whole bunch of fat business people in suits.
Look how thin we are.
That's right. Well, the bottom line is, you take a client out, you win a client over for $200,000, it's a new job for somebody, it's tax to be paid, and it's GST as well. The long lunch, bring it back. I'm Peter Switzer.
I'm Paul Rickard.
And we're mad about money.